It has begun. The lockdown you were never supposed to see just went live. China's largest silver investment vehicle didn't pause trading. It didn't slow down. It froze. The UBS SDIC Silver Futures Fund has been suspended more than 25 times since December. That's not volatility management. That's a system in cardiac arrest. They locked the doors while people were still trying to get in. Think about that. In a market crash, people run for the exits. Selling, panic, liquidation. But this wasn't a crash. This was a stampede in the opposite direction. Chinese investors were paying 100% premiums, double. They were paying the equivalent of $150 per ounce when the rest of the world saw $74 on their screens. This wasn't irrational exuberance. This was mathematical panic. People who understood that physical silver was disappearing were willing to pay anything, any premium, any price, to secure exposure before the system locked them out completely. And the system did exactly that. It locked them out. The media is calling this investor protection. They're saying regulators stepped in to shield retail traders from dangerous volatility. That's the narrative. But I have the documents. I have the timeline. I have the premium data that proves what really happened. Trading was halted because the buying pressure exposed a truth the system cannot admit. The physical metal doesn't exist, not in the quantities the paper contracts claim, not in the amounts the fund was supposed to represent. The Chinese market just proved that the global silver price is an illusion. And when that illusion cracked, when Chinese buyers were willing to pay double to get real exposure, the authorities didn't let the market clear. They shut it down. Because if they hadn't, if they'd let that buying frenzy continue, everyone would have seen what I'm about to show you. The warehouse is empty. The vaults are being drained. And the $74 price you see on your screen right now is nothing more than a number printed on contracts that cannot be delivered. Same pattern, same sequence, same outcome. This isn't the first time a financial system has collapsed under the weight of promises it couldn't keep. History has shown us this movie 3 times before. 3 empires, 3 different centuries, same mathematical certainty. The Roman Empire spent 200 years debasing their currency. They started with a denarius, a coin that was 95% silver. But when the wars became too expensive, when the borders became too costly to defend, when the promises to soldiers and citizens became impossible to fund, they did what every dying empire does. They diluted. They debased. They replaced silver with cheaper metals and told everyone the coin was still worth the same. By the time Rome fell, the denarius was less than 5% silver. The people knew. They stopped trusting the currency. They hoarded the old coins, the ones with real metal. They demanded payment in gold and silver, not the government's new tokens. The empire printed its way into hyperinflation and collapse. The entire monetary system disintegrated because the physical backing disappeared, while the paper promises multiplied. Verified. Move forward 1,000 years. The Dutch Empire, the wealthiest civilization of the 17th century, controlled global trade. They had the guilder, the reserve currency of Europe. But then came the wars with France, the wars with England. The cost of defending their trade routes became unsustainable. They borrowed. They issued bonds. They made promises backed by future prosperity that never came. The debt spiraled. The silver and gold reserves were spent on war. The guilder lost its backing, and within a generation, the Dutch went from the richest empire on earth to a secondary power. Their currency collapsed, not because of military defeat, but because the physical reserves backing their money were exhausted while the paper claims kept growing. Check. Now look at Britain. The British Empire in 1914 controlled a quarter of the planet. The pound sterling was the global reserve currency, backed by gold. But 2 world wars cost more than the empire could afford. By 1945, Britain was bankrupt. They owed debts they could never repay. The gold reserves were gone, shipped to America to pay for weapons, spent on survival. And when the world realized Britain could no longer back the pound with gold, the reserve currency status evaporated. The pound collapsed. The empire collapsed. Not because they lost battles, but because the physical assets backing their monetary system were depleted. Verified. 3 empires. 3 collapses. Same underlying mechanism. The physical reserves are exhausted while the paper promises multiply. The currency loses credibility. People panic. They rush to convert paper into something real, something tangible. And the system locks the doors because it cannot deliver what it promised. We are watching the 4th iteration right now. And China just gave us the proof. On January 1st, 2026, China implemented a new export licensing system for silver. They didn't announce it with fanfare. They didn't hold press conferences. They just quietly elevated silver to the status of a strategic material, the same classification as rare earth elements. Only 44 companies in the entire country are now authorized to export silver. 44? That's not a free market. That's a controlled choke point. China locked the exits. They trapped the metal inside their borders. And the reason they did that is simple. They know what's coming. They know the global supply is running out. They know that in a world of fractured trade relationships, resource wars, and collapsing trust in fiat currencies, physical commodities are the only real wealth. And they want every ounce of silver inside China to stay inside China. But here's where it gets darker. After they locked the exits, they locked the entrances. Starting in early December, the UBS SDIC Silver Fund began issuing unprecedented risk warnings. The fund was trading at a 12% premium over its net asset value. That means investors were paying 12% more than the fund's actual holdings were worth just to get silver exposure. By December 26th, the premium hit 60%, 60. The fund closed Class C subscriptions entirely. They told investors, stop buying, the premium is too high. This is unsustainable. But investors didn't stop. They accelerated. The desperation intensified. By late January, the premium exceeded 100%. Chinese investors were paying more than double what the fund's underlying silver was supposedly worth. Think about the psychology of that. These are not stupid people. These are citizens of the second largest economy on Earth. They have access to information. They understand markets. And they were willing to pay double, 100% premiums to secure silver exposure. Why? Because they understood what was happening. The export restrictions, the inventory depletions, the global system fracturing. They saw the doors closing and they were trying to get in before it was too late. On January 22nd, 2026, the fund suspended trading for the entire day. Market open to market close, frozen. The official reason was the premiums were too high and posed speculative risks. But ask yourself this. If the premium is too high, why not just create more fund units? That's how these vehicles are supposed to work. When demand is high, you create more shares, sell them at the premium, pocket the difference. The premium collapses back to normal levels. That's arbitrage. That's basic market mechanics. But they didn't do that. They couldn't do that. Because to create more fund units, you need to buy the underlying silver to back those units. And the silver wasn't available. The physical market couldn't deliver. So instead of admitting that, instead of letting the premium expose the shortage, they suspended trading. They locked the doors. January 28th, all subscriptions were halted. Not just one share class, all of them. Automatic investment plans, regular purchases, everything. The premium was still climbing. It hit 36% over Shanghai futures prices, even after multiple suspensions. People were still trying to get in, and the fund kept locking them out. Then came February 2nd, the nuclear option. UBS SDIC announced they were changing the fund's valuation methodology. Instead of using Shanghai futures exchange prices to calculate the fund's net asset value, they would switch to major international silver futures markets. Translation. They were going to stop using Chinese prices and start using COMEX prices. The result was catastrophic. The fund's net asset value collapsed 31.5% in a single day. The largest single-day decline in Chinese public fund history, ever. Not just for silver funds, for all public funds. 31.5% gone in one session. But here's what that really means. The Shanghai price and the international price had diverged so massively that when they marked the fund to Western prices, the gap was exposed. Chinese silver prices were trading 30 to 45% above Western prices. That's a $76 per ounce difference. In a normal market, arbitrage closes that gap. You buy silver in New York at $74, ship it to Shanghai, sell it for $110 or $120, you make a fortune. The gap disappears, but the gap didn't disappear. It widened. It persisted. It grew to 45.8% according to the latest data. That tells you everything. The metal is stuck. It cannot move. China locked it inside with export restrictions. Western vaults are being drained and cannot spare it. The global silver market has fractured into two separate realities. The West has paper. The East wants metal. And the $76 gap between them is the mathematical proof that the unified commodity market is dead. We are not at the cliff. We have already walked off it. The free fall has started. You just haven't felt the impact yet because the system is doing everything it can to hide the ground rushing up. But you can see it in the data. Shanghai silver inventories hit a 10-year low in December 2025. Not a temporary drawdown, a structural depletion, 10 years. The lowest level since 2015. At the same time, COMEX registered inventories, the silver available for immediate delivery against futures contracts, bled out at a record pace. Between early and mid-January 2026, 33.45 million ounces were physically withdrawn from COMEX vaults in 7 days. 7 days. That's 26% of registered inventory removed in 1 week. Both ends of the global market are running dry simultaneously. Shanghai is empty, COMEX is hemorrhaging metal, and the London Bullion Market Association, the third major hub, is showing stress signals, lease rates spiking, backwardation in futures markets. All three global silver trading centers are experiencing supply constraints at the same time. This is not a local issue. This is not a Chinese anomaly. This is a global system breaking. And the 45.8% Shanghai premium is the fire alarm. It's telling you that in at least one major market, physical reality has completely divorced from the paper price. And if it happened in Shanghai, it will happen in London. It will happen in New York. It will happen anywhere that physical demand overwhelms the paper contracts pretending to represent that metal. Now, let me show you the coordination. Because this wasn't random. This wasn't organic. On January 20th, Chinese billionaire trader Bian Ming placed a $300 million short position on silver. $300 million. This is the same trader who made a fortune calling gold's record rally. He knows how these markets work. He knows how Chinese regulations work. He's connected. And he placed a massive bet that silver would crash right before the fund suspensions began and right after the export restrictions took effect. He knew. The doors were closing. The system was fracturing. And he positioned accordingly. Whether he was betting on the paper price crashing while physical was trapped, or whether he was shorting to cover later and convert to physical, the fact remains. A billionaire insider made a $300 million move days before these events unfolded. That's not luck. That's advanced knowledge. And if you're a retail investor getting your information from financial media 3 days after the moves happen, you're playing a game where the outcome has already been decided. The insiders have already positioned. The governments have already restricted exports. The funds have already locked retail investors out. And you're being told the market is crashing, it's bearish, you should sell, while premiums in China are hitting 100% and regulators are suspending trading to stop the buying frenzy. Same pattern, same sequence, same outcome. This is what the collapse looks like before the masses realize it's happening. The Romans debased the denarius while telling citizens the coin was still good. The Dutch issued bonds backed by gold they'd already spent. The British printed pounds backed by reserves that had been shipped to America. And now, the global financial system is trading silver contracts backed by metal that doesn't exist in the quantities promised. The fracture has started. The two-market reality is here. In the West, silver trades at $74 on screens. In the East, investors were willing to pay $150 equivalent before they got locked out. That's not a bear market. That's a shortage. Bear markets happen when nobody wants the asset. Prices fall because demand collapses. But that's not what happened here. Prices fell in the West while the demand in the East was so extreme that regulators had to suspend trading to prevent a run. That's the opposite of a bear market. That's panic buying disguised as a crash. The paper price is collapsing because leveraged traders are being forced out. Margin calls, liquidations, futures contracts being dumped. But the physical market is tight. Inventories are at decade lows. Export restrictions are in place. Premiums are spiking. And the people who understand what's happening are trying to secure metal before the system locks them out completely. You can't unsee it. Once you understand that the Shanghai premium is mathematical proof of a fractured market, you can't go back to trusting the paper price. Once you see that China locked the exits with export restrictions and then locked the entrances by suspending the only fund giving citizens silver access, you can't pretend this is normal volatility. Once you realize that Chinese investors were paying double the international price and regulators had to shut down trading to stop them, you can't believe the narrative that silver is crashing because demand is weak. Let me tell you what this looks like for you. For the person watching this who doesn't trade futures, who doesn't have a vault in Switzerland, who just wants to protect their wealth, the system is bifurcating. On one side, there's the paper world, COMEX contracts, ETFs, fund shares, numbers on screens that represent claims on metals stored in someone else's vault. On the other side, there's the physical world, coins you can hold, bars in your possession, allocated storage where your specific serial numbers are registered to you, tokenized systems with cryptographic proof of reserves. The gap between those two worlds is widening. Right now, you can still buy physical silver at prices close to the paper price. But in Shanghai, that gap exploded to $76. The people who waited, who trusted the fund, who thought they could always get exposure later, got locked out. They're now watching from the outside, while the metal they wanted to buy is trapped behind export restrictions and suspended markets. The same thing will happen in the West if physical demand overwhelms the available supply. The paper price might say $74, but the price to actually get metal delivered to your door, the premium you'll pay over spot, will spike. 10%, 20%, 50%. And if the shortage becomes severe enough, the premium becomes infinite because there's no metal available at any price. That's what the Shanghai situation is showing you. A preview, a warning. When the physical runs out, the paper price becomes irrelevant. Only the physical price matters. And that price is whatever desperate buyers are willing to pay before the doors close. This is the wealth transfer. Not might happen. Will happen. Every time a financial system collapses under the weight of unpayable debts and unbacked promises, wealth transfers from those holding paper to those holding physical assets. The Romans, who hoarded old silver denarii, survived. Those who trusted the debased coins were wiped out. The Dutch, who converted their guilders into land and gold, preserved wealth. Those who held bonds issued by a bankrupt empire lost everything. The British, who moved their savings into hard assets before the pound collapsed, retained purchasing power. Those who trusted sterling were destroyed. And now, in 2026, the same transfer is beginning. The people who understand that the $74 paper price is a gift, a temporary disconnect from physical reality, are converting. They're buying coins. They're taking delivery. They're moving to allocated storage. They're using tokenized platforms that provide cryptographic proof the metal exists. The people who trust the system, who believe the media narrative that silver is crashing because demand is weak, who think they can always buy later, are going to wake up one day and find the doors are locked. Just like Chinese retail investors found out. They were willing to pay $150. They were desperate to get in, and the system shut them out. By the time they realized the shortage was real, it was too late. The fund was suspended. The export restrictions were in place. The metal was gone. Do not let that happen to you. The smart money is leaving the paper system. Project Vault. The U.S. government just announced a $12 billion critical mineral stockpile. Governments don't build strategic reserves of worthless materials. They build reserves of materials they expect to be scarce and strategically critical. $5 billion has migrated from paper gold ETFs into tokenized, blockchain-verified physical gold in the last few weeks. Institutional investors are abandoning paper claims for cryptographic proof of reserves. They're not doing that because they're bored. They're doing it because they've seen the Shanghai premium data. They've seen the COMEX inventory drawdowns. They've seen the export restrictions. And they're positioning before the masses figure it out. You're watching the global silver market break in real time. The fracture is not coming. It's here. The West has paper contracts that cannot be delivered. The East has demand that cannot be satisfied. And the gap between them is $76 per ounce and widening. When the March COMEX delivery period arrives, we're going to see if the system can handle the strain. Projected demand is 70 to 80 million ounces against registered inventory of 95 to 107 million ounces. If even half of contract holders stand for delivery, if they say we want the metal, not cash settlement, COMEX will face unprecedented stress. Do they deliver? Do they force cash settlements? Do they change the rules mid-game the way the London Metal Exchange did when the nickel short squeeze broke the market in 2022? Any of those outcomes destroys confidence in the paper system and accelerates the migration to physical. And here's what keeps me awake. What happens when other commodity funds in China face the same pressure? Silver is not the only strategic material under export restrictions. Rare earths, tungsten, antimony, gallium, all restricted. If Chinese investors rush into commodity funds the way they rushed into silver, and those funds get suspended the same way, the entire market structure fractures. Regional silos form, export bans spread, price gaps explode, arbitrage breaks because materials can't move. This isn't speculation, it's pattern recognition. China restricted silver exports. Weeks later, the fund hit extreme premiums and was suspended. That's cause and effect. That's a system cracking under shortage pressure. The global silver market uses more metal than it produces every year. The gap is filled by above-ground stockpiles. But now governments are hoarding them. Shanghai inventories are near decade lows. COMEX is bleeding millions of ounces. Export limits are tightening. Funds are frozen because there's no metal to back new units. Premiums are surging because buyers know the shortage is real. They don't suspend trading when supply is strong. They suspend it when demand is about to expose empty warehouses. The paper price is psychological warfare. It's meant to scare weak hands into selling. Meanwhile, governments are building reserves. Institutions are moving into physical. Insiders are positioning early. This is the same historical pattern. Physical runs out, paper multiplies, systems fracture. The only question is whether you'll be holding promises or metal when it breaks.